other roommates paying my mortgage. But I guess ultimately what I'd love to get from this course is just the knowledge to become financially independent and just really learn more about underwriting deals, raising capital, and yeah, just helping me on this journey to financial freedom. So excited to be here. Thanks for having me.
And you are brothers with two other people on this call right now.
Yes, sir.
Russell did not mention last time because you guys weren't here, but I'm going to mention
it. Yeah, I apologize.
Jude, Ben, and Thomas, you go by Russell, but all our last names are Russell. It can be confusing, but anyway. All right, what about you, Ben?
Yeah, my name's Ben Russell. Like you mentioned, my other two brothers are on here. I'm a project manager for a HVAC company in Michigan. And basically I just own my own personal house, married with a 6-month-old and 6-week-old. And yeah, I'm just trying to start from the ground up and really dive into this and get everything I can from it and hopefully start being able to bring something to the table.
Wow, 6 weeks. That's a fresh baby, man. Congrats.
Thank you. Appreciate it. I'm on sitter duty, so I apologize if I'm unmuted and you hear a scream in the background.
Hey, Ben, we call that just being a father, by the way. So
Awesome. Appreciate it. Well, she's, right here with us. So I'll do my best to keep her on the DL.
Educating her young.
That's right. That's right. You put her to sleep at night reading Rich Dad Poor Dad, as you should.
That's right. Yeah, listening to podcasts. So she'll be catching up with us soon.
Oh, that's great. All right, and the last new face scrolling through everyone's faces is you, Dallin.
Right on. Can you guys hear me?
Yeah.
Okay, right on. Yeah, Dallin Seeley. I'm out here in Utah. I'm an insights manager at a company called Class Research. Do a lot of healthcare IT research. What I'm looking for the mastermind is kind of similar to a lot of other people: financial freedom, time freedom. Like to spend a lot more time with my wife and 2 boys. Soon to be a third. Not sure if it's a boy, but soon to be third child here in October. So yeah, I would just love to spend more time with them and go do fun stuff. And yeah, so that would be it.
Have a blast. What did you say where you were based out of? Did I miss that?
Say it again.
Did you say where you were based out of? Did I miss that?
Yeah, out in Utah.
Utah. For anyone else out there who may be is it Utahanian? Utahn?
Utahns.
Utahn.
Yep.
Okay. Oh, fantastic. All right, well, Reggie, I think you were going to be the leader of today's our first beginning of this whole advanced cohort that we're launching, where we spent a little over an hour today chatting amongst the 3 of us, putting together some curriculum for you guys between how we're kind of splitting this out, with Monday being kind of the beginner cohorts and Thursdays being a little bit more advanced. So, Reggie, let you take it away.
You want to let me share my screen? I'm going to run the visuals here and we'll kind of knock this out.
All right. Should be good.
Yeah, Matt's going to drive and I'm going to gab, and he's probably going to gab too. So.
Yeah, buddy.
Market quadrants.
All right. So, hey, glad to be here, everybody. Thanks for joining us. I think, tonight we've decided to do a little deep dive into market analysis. And so kind of as to set the stage for that, I wanted to talk about the real estate cycle. So back, I don't know, I think it was 1933, this guy named Homer Hoyt, he observed that real estate goes through approximately these 18-year cycles. And he kind of quantified the cycles as you kind of see in this chart here. And it's shown to be true ever since he put this book out. I think it was called 100 Years of Land History of Chicago. You guys are interested in reading more about that. But basically, he broke up the real estate market into 4 separate phases that it goes through, and it kind of oscillates through each one. There's no set time period for each phase, but the whole cycle itself, it takes approximately 18 years or so, give or take. And there's a few things that affect that, but we can talk about it. So initially, if we just start at the recovery phase, this is a time in the market where you'll start to see things bottom out. So you'll see low vacancy rates in commercial and residential investments. You'll see negative rent growth, or at least rents kind of being stagnant, and you'll still see declining vacancy. And so as you kind of move up the curve a little bit, you start, if you look at the x-axis and the y-axis, okay, so on the x-axis, this is going to be time, and as you move up and down, that's your occupancy level. And so you can kind of see that the dotted line that goes back and forth, that signifies the long-term occupancy average. So, as vacancies start to kind of rebound a little bit, and during this time, you won't see any new construction because it just doesn't make any sense. Builders are scared, and this is especially so since, the 2008 crisis isn't that far behind us. But you'll start to see things rebound. People start getting a little more courage. They'll get a little more brave with their capital, and you'll move into what they call the expansion phase. So you'll know when you kind of reach this point because you'll hit that long-term average occupancy, instantaneously. So that's kind of like the turning point. At least that's where this guy Homer Hoyt pinpointed to that. So you'll start to see occupancy slowly increase, and it kind of feeds on itself, right? Because as vacancies decrease, investors like us are looking at that across the board, and it makes things more competitive. It drives up market values of properties. Sellers decide, to start selling again, and it just kind of begets some additional transactional activity. So it's as you move to that long-term occupancy, you'll start to see that people are starting to, construct houses again. They're starting to build again, and that's when you kind of reach that demand supply equilibrium point where things kind of max out, and that's when you'll start to see speculators come out of the woodworks, and things will feel kind of hot. And I don't know, if you guys have been doing this for more than a year or two, then during COVID, I'm sure you had a kind of a sense of that. You could see it in the news. And so this period of expansion, it kind of ends when current rents reach new construction rent levels. So if you were to build a new house or a new multifamily property, and you can get $1,000 a month for it, but all the neighboring multifamily properties that are 20 years old are getting around the same rents, you're probably close to that equilibrium point. That's when you enter that phase 3. That's that hyper supply phase where the market's heated up. Rent growth is still positive, but it's declining. So it's not accelerating anymore. You're not seeing 3% this year, 4% next year. It's going, the numbers are going down. And then you'll start to see the occupancy kind of trend back toward the long-term average. And that's when you start seeing a lot of the new construction coming online. You'll see those completions come up. And then when you hit that long-term occupancy, that's when people start getting scared, at least the folks that are familiar with the cyclical nature of this, because they know what's next. After 2008, the whole 2010 bubble, we had a pretty prolonged recessionary period, longer than a lot of people thought or projected anyway. And so that's when things start cooling off. But there's a lot of things that affect this, and I think we can talk a little bit more about that. Matt, did you want to start pulling up some of those?
Sure.
Some of those resources there.
Sure. Yeah. Before we kind of move off the graph here, I'm going to kind of pull the audience with this everyone in the room. Actually, hold on, Josh. Can you do a poll? Do you know how to do a poll? I'm curious,
but I can figure it out.
All right. Well, maybe for another question, we'll figure it out or next time. where do you guys think we are currently as a broad economy in the cycle? Now, obviously, this is going to be hyper local, right? This can be a regional discussion. This could be a general discussion, it could be a worldwide discussion, really. But where do you think we are as a whole within the UAS right now, as far as which phase of the real estate cycle? Just curious.
Somewhere between hyper supply and recession.
Hyper supply and recession. And anyone disagree?
Yeah, probably the same, transitioning from phase 3 to phase 4.
Yeah. I would agree with that as well. Reggie and Josh and I, we've had similar discussions on that. Do we think we're in recession yet? And if so, what do you think the indicators will indicate that we're actually in a recession? Because a lot of people are hesitant to say that the R word, because they fear it's going to freak everyone out. So at what point would it take for everyone in this room? I'm curious, at what point would it take for you to say we are in a recession versus we are in hyper supply?
Lower interest rates.
Lower interest rates. Interesting. Okay. Paul, were you going to say something?
Well, yeah, I mean, obviously, once the Fed stops to cut rates, and like the fellow just said, lower interest rates, is definitely because the Fed feels that we're in a recession at that point. But
Yeah.
we're starting to, honestly, I was thinking we were probably already in that phase 4 going into that phase 1, kind of still early beginning stages, just because of the fact that you still have construction that is onboarding still.
Interesting. So you think we're over here? You think
Yeah,
we're kind of,
because
Okay.
you're going to see those. You're already seeing the declining vacancies, right? So now some of the, well, again, I'm just looking at what's going on in Houston.
Mhm.
You have some tenants that are already moving, and now there's deals that are being made in regards to offering, hey, first month's free type situation. So yeah.
Interesting.
That-
Okay, cool. And like I said, it's going to be interesting to hear the different local, regional kind of thought process, because our regional experiences, wherever we are definitely going to kind of color how we view what we think the nation's doing as a whole, right? If you guys are in an area like Lake Charles, Louisiana, that's been hit by 3 hurricanes and a massive flood, and you're like, dude, the world is going under. Like literally, we're all dying. Versus, if you're in Miami, that just continues to boom and boom and boom right now, you're gonna be biased one way or another towards the national average. So we'll look at some of the stats here as we jump into some specific websites. My personal take is I don't think we've seen vacancy increase to the point that we're really at a recession. So I still think we're kind of in that transition down here. And to that point, will we stick? Who knows? Like a cycle doesn't need to be this, like a sine curve of this great, this kind of equal pacing, if you will. It is a general trend across the board, but doesn't mean they need to be such great, amplitudes on every side of that sine curve. So it's going to be interesting to see.
My
Go ahead, Paul.
apologies. I didn't realize on that curve, it said declining vacancy as it was going up. To me, I was thinking increasing vacancy. So yeah, I'm on the other side. Apologies.
Yeah, no,
So-
you're all good. It's all good, and that's why I want to go over these to make sure we understand kind of the thought process here, because it makes sense, right? At this point, we're still building. That's what the equilibrium point, supply and demand are here, and we know we've crossed this point, right? It's pretty obvious as a nation. We went from, it was crazy seller's market because the supply was so low, occupancies were ridiculous, and we've reached this point sometime in the past. It definitely started after April of last year. April of last year is when the first Fed rate hike happened. And between April and probably July of last year is when this point hit and we noticed it. Really, Q4 of last year was the noticeable where, man, things dried up. Like Q4 was tough, commercial, residential across the board. I think it was just like the mixture of the holiday season plus interest rates continue to spike higher. And so that was the point that we were definitely started to notice a trend in the vacancy increasing kind of range, as well as prices softening and everything else kind of going on. On the multifamily space, cap rates stopped suppressing as much. Luckily, cap rates have still kind of stayed relatively consistent. And will that hold? We'll see. I don't know. At the end of today, after the lesson, we'll kind of talk through some insights that Josh had put a post out on his social media about kind of I was at a event that we'll talk through kind of the struggles that a lot of these bigger multifamily groups are going through right now. And it's and I'll say the struggle is real right now. there's some potential for some big bubbles to burst within some of these multifamily groups right now. So,
I have a question.
Yeah.
You hear everybody in the greater US market saying, well, rents are increasing and housing prices are increasing so much because of historical lack of supply that has existed since 2008.
Yeah.
So I'm not debating your point. I'm more asking how it plays in, because, that's what we hear from everybody, right? Is that there's still this dramatic need for housing supply. And you would think that that would not lead to increasing vacancy.
The other thing that's interesting, to riff on your point a little bit more, is you say we hear from everyone, but the way we kind of get fed our data in today's world is so funny, because whatever you start to click on, your devices are going to continue to feed whatever that is, whatever that trend data is. If you're a Dave Ramsey fan, you can continue to watch Dave Ramsey stuff. I'm not saying one way or another, you like him or hate him, but he's he's still very bullish about the market. He's saying, well, we have supply still at an all-time low, and he's super bullish about what he's doing. He's also got a ton of investments that he doesn't want to drop out with the way that he's kind of flowing his stuff. And he has a very large audience and a very big influence on the way the market can trend. If Dave Ramsey were to say, I'm selling everything, guys, I'm getting out, you better believe you'd see a swing in whatever market that he's trying to influence. And so that's one example. There's other examples. There's plenty of YouTubers who have been saying the sky is falling for the past year. And if you watch those guys, you're surprised that anyone still has any money, because you thought the market dropped a year ago. So we'll talk to some specific stats. And I think, to your point, as far as people are claiming that, we still have this a massive lack of supply versus the population and everything else. There's so many other factors that go into that, as far as even generational kind of differences, right? You look at Gen Z, who are typically proud home buyers by the time they were 25, versus the millennials. They're very prideful. They're very happy to be living with their parents at 30. You know what I mean? So there is kind of a generational gap as far as supply and demand in that regard, as far as what is the true demand versus what is the true supply. So that's a good point, though, to bring up, Rob. All right.
Hey, Matt, I want to piggyback off you real quick. So I guess a point about real estate and rent growth and inflation and interest rates. I believe that we're sitting on a one-legged stool right now, and that one-legged stool is short supply. If we didn't have short supply, it'd be a much different story right now. And I think that might be the only thing that saves us from, I guess, what the Fed's calling a hard landing. But if you think about it, they're trying to push us towards recession, but they want unemployment to go up. And one of the ways they're doing that is increasing interest rates. And if you think about it, that affects the housing market considerably. I mean, just one little rate hike can send rates soaring. Demand can be off the next month. But consider this, real estate is 13% of the US's GDP, which is the best primary indicator of economic growth. And so if you think about what they're doing there, it's pretty intentional. Rents may still be increasing, but they're increasing at a slower rate. And that's what we're watching. That's what we're watching them. It's going up still, but it's slower and slower. And I think we're about to hit that inflection point.
Yeah, and there are areas like for instance, Tampa. Like I'm located in Tampa right now, and they are noticing. We just looked at a market update. What was that? A couple of weeks ago that you had sent out, Reggie, in our internal Slack channel that was to talk about the Tampa market overview, and they were showing a decline in certain classes of because the guy breaks it down, which we'll talk. We're going to talk about supply and demand in a different lesson and understanding and deep diving like CoStar reports. But in that understanding is it's even within a market, it's going to be class dependent, right? Like in Tampa, the Class A market has been ridiculous. Rents have been rising, occupancy has been crazy, and it's been doing very, very well. But there has been an oversaturation recently in Tampa with all the new supply that hit, and so they started to see a dip in the Class A and rent demand. So it just there's a ton of variables at play for sure. The one thing I will say, another big, I'll say big, but it is a variable that has changed things. Was I don't know if you guys have read the book What It Takes by Steven Schwarzman. He runs BlackRock. He it was an awesome book. And what he talks about though is when they decided to jump into buying bulk residential real estate as a massive whatever, I don't know how big BlackRock is, 2 billion, 200 billion, I have no idea, some massive firm, right? Once they decided to start buying residential real estate, you might be asking, like, how does that affect multifamily real estate? What it does, it starts to really shrink the supply almost artificially, and also pushes more people to the multifamily space because they can't buy now because investors are buying these houses, and rent growth is a little different in the residential versus the multifamily space. There's always a bunch of variables at play to consider, but all in all, you can trust that a cycle will occur. And again, what is the amplitude of the cycle? It's going to vary, but in general, we're seeing the cycle now. I still think we're in this kind of downward trend of increasing vacancies. I think we're going to continue to see a flow of increasing vacancies, barring some dramatic government takeover again. I think we should have experienced this already 2 years ago, to be honest with you. But when government introduced some massive inflation into the economy, that really changed everything. So we almost had we were here, and then they burped, and it was like a little like a fake. It was a fake out, right? Like 2000 when COVID hit, it was a fake out. But anyways, all right. So let's jump into the first one, Reggie. The first one we'll talk to GDP growth. And so I'll set the stage for you, Reggie, and I'll kind of give a precursor to the one things we're trying to do for you guys. So one of the things our plan is to try to build an internal analyzer for everyone as part of the group here to really hopefully set the stage, kind of a soup to nuts type of analyzer. This is precursor. This is extreme beta right now. But one of the parts of the analyzer here is going to have national and local factors to consider before, as far as part of your market analysis before you actually analyze your deals. And so from here, I'm just kind of going down the different links of understanding, GDP through absorption and the different, how you can kind of rate these things. We're not going to talk about the rating scale. We're not going to talk about the analyzer, but this is kind of the big picture behind the scenes for what we're kind of trying to build for you guys. So GDP, Reggie, I'll let you kind of jump and discuss kind of big picture GDP. Where this is taken from BEA.gov, which I can't remember what BEA stands for, some government agency.
Yeah, it's like the Bureau of Economic Analysis, I think.
Advancement, I think.
Economic advancement. Yeah. So Reggie, if you want to discuss big picture GDP kind of considerations.
Yeah, so if we're talking about GDP from a U.S. perspective, just gross domestic product, it's what we use as a signal of, or an indicator of growth or not. And so, for a developed country like the US, 2 to 3% is going to be typical for us. We've kind of plateaued as far as our growth goes. When you have like a third world country, or should I say an emerging economy like Brazil was a few years ago, like China was 15 years ago, man, their GDPs could have been double digits. Now, that can also be a bad thing. I think it was, what country was it? Years ago, they had that horrible hyperinflation. They had, inflation.
Was it Venezuela? Who was that?
I think so. It was one of the, I think it was one of the South American countries, but they, their GDP, percent change from the preceding quarter, it was like, hundreds of thousands of percent. And it would change, dramatically over the course of the day. But this is something typically that you look at when you're trying to, set the background. Now, there's a national number, and that's easily obtainable, but you can also get local numbers for MSAs. So you might not have it for, that Timbuktu town in the middle of Iowa with 2,000 people. But if you go to your closest MSA, if you go to, Miami-Dade, or if you go to, New Orleans, or, a bigger city like that, there's usually some publicly available data, maybe Chamber of Commerce, something like that. But I look at that as an indicator for the health of the economy there, just, general health. And it's just one data point. And so we look at the data point, the most recent data point, but we also like to look at the trends. Because, today, last quarter's number might have looked good, but what if it's the lowest number in the last 4 quarters and it's just been going down? Well, there's a downward trend there. So all things considered, but that's basically at a high level, you want to see some healthy GDP, like positive growth, 2 to 3%, and very little headwinds that might affect that.
Yeah, and to your point, you can start to see the trends now. Now, anything positive here is change from the preceding quarter, right? Which is what he's saying as far as trend. You want effectively that 2% growth per quarter, which allows people to have confidence that their money is going to continue to grow in general. But so we still see growth here, to Reggie's point, but you can see the declining growth over time. And so I'll be anxious to see if we start to slip into some negative growth territory as we kind of start to see future quarters get announced there.
So did you guys want to spend like 2 minutes and just talk about the factors that affect the growth or decline of GDP?
Reggie, I'll let you jump on that one.
So there's a bunch of things, and it's a nuanced type of number. It's interesting because I'll use this as an example. Look at 2020 Q2, Q3. COVID blew up around March, April, and was really, things got shut down in Q2. So people stopped spending. There was, a lot less consumer spending. Some things boomed. You couldn't find toilet paper, and there were other things you couldn't find. But all in all, people were still spending money, just not nearly as much. Nobody was driving. Oil and gas industry was, it was a famine at that time for those folks. But then in Q3, that's when the government started printing all the money. They pumped almost $5 trillion into the economy, seemingly overnight. And then you see this massive swing, and that's when things started to open back up. And you can see things were a little hot after that. I mean, we were pushing 7-8% in 21. And so, that's just kind of one of the I guess consumer habits and governmental spending plays into it. So it also looks at exports. So import-export activity is included in GDP. And there's a few other ones. I don't remember the formula offhand. There's like 5 variables. But consumer spending and governmental spending plays a big part in that. So something to think about from a macro perspective.
Yeah. To not weigh down too heavy on it, but yeah, I think wages, tax cuts, valuations. I mean, they look at investments. I think there's a bunch of stuff that kind of go into GDP. I'm definitely not an expert in the area by any means. Cool. So GDP is definitely one big picture consideration to look at as just where we are in a cycle, and that in general, is this going to affect a micro? Hey, can I boost rents in the Sacramento, California area? Like maybe, but probably not from a big picture. It's more of a confidence builder, and one of the things as you start to potentially something if you want to bring into your briefs with your investors. And so as if it's promising, not that I would intentionally conceal data from my investors, but if there's promising information that I could bring into my brief when I have my slide deck for my actual pitch deck, this is something you could bring in. Hey guys, GDP growth, we were hurting, but look, we're looking at good positive trend across the board as just national trends. Bam, to the next slide. Again, one more kind of confidence factor that you kind of bring to your investors to discuss. All right, next one going down the line, we had unemployment in general.
Yeah, so unemployment is one where, I mean, it's pretty common sense, right? If people are working, people are making money, they can pay their rent. So if you see unemployment tick up, even just a few, tenths of a percent on a national level, that can represent millions of people. Now, that the devil's always in the details, right? And so the unemployment is there's a very specific definition for it, but it looks at kind of carves out the people that participate in the labor market, and takes a percentage of that. And so, that's one thing you might also want to look at too. But just, from a standard point, you want to look at the long-term average of unemployment in a market and compare to where it is now and how it's trending. And that will tell you directionally, it'll give you some idea about what the economy is doing. And then you can go back and look at the GDP, and that data should support some of the conclusions that you make when you're looking at things like unemployment and even inflation and interest rates, which I think we'll talk about in a moment.
Yeah, we'll talk about those here soon. And it's good to see like micro. So the Bureau of Labor and Statistics, they're going to have the micro month by month data that you can kind of break it down even into age gaps and everything, understanding kind of what everything looks like there. And so you can see 3.6 to 3.4, very minimal variation from April of last year through April of this year, which is great to see. Like as far as, and that's a low unemployment percentage. So that makes me feel good for sure. And you can see a big picture if you want to like look longer term, you know, where were we in 2003, 20 years ago versus where we are now. And, you know, we know where we were in these market cycles before when, you know, everything dropped out in 2008 timeframe, came back up. So this would be that recessionary period. And then we see another factor consider where we are in the market cycle. This is again why we had that almost fake burp with that lull where I feel like we should have been in the market cycle. So anyways, good to look at long-term trends there as well. All right.
Yeah, and I think most economists consider anything above 5 to be high from a U.S. standpoint.
And it's also good to consider the national. Well, we're going to talk more specifics again about regional market and CoStar reports and micro stuff in either next week's or in 2 weeks. Next week we might get more political economic, but it's good to compare the national average, which we do almost every time with our pitch decks as well. The national average versus the hyperlocal or MSA unemployment average. And so it's good to say, okay, the national average 3.4%, but in Tampa Bay, we're looking at 10% unemployment. Like there's some disparity there that you need to address and understand what's going on. Like why is there such an exodus or why is there such an issue? A lot of the times it may be, if you're in a secondary or tertiary market, it may be the fact that a lot of that population depends on one employer. And that is, one of the factors we'll talk about when we're picking MSAs to not necessarily to avoid, just something to be aware of the factors that could be at play. All right, next one. We were looking at inflation.
Oh yeah, I love this one. Yeah, so inflation, it's a funny thing, and the definitions changed over the years, but basically the government takes this, big, supposed to be a random basket of goods. It assigns a value, to all these goods, or it indexes the value starting at a specific time period. And then the index changes over time. They go out and they take an average of what eggs cost. They go out and they look at rents. They look at home prices. They look at a bunch of different things, and then they wrap it all together. And basically, that's where the CPI comes from, Consumer Pricing Index, and so kind of gives you an idea of like it is tied to GDP. It's tied to things like unemployment. Because you'll see these trends change together. They might not be doing the same things, moving in the same direction, but they tend to change trajectory at the same time. But inflation basically is just telling you for the past 12 months how have prices changed year over year, like in general. And typically 2 to 3%. I think 2% is the Fed's target. Anything I think positive they think is good. Anything above, when you start getting past 3%, that's when they start raising rates or might be some quantitative easing that comes along with that. But there are some things that the Fed can do to change that, and that's one of the reasons that they're manipulating interest rates right now, is to try to keep inflation in check. And I mean, you can see from the graph here, they're already doing that. Matt, if you want to talk a little bit about this part.
Yeah, so what the first one was, this is from what is the name of this organization again that we pull from? This is more like a worldwide organization, the OECD. Again, sorry, I don't ever remember what the hell these organizations stand for. This is more broad. You can see the Euro area in general. It's good to compare, nationally, kind of what everyone's comparing. And then this is forecast as well. So how much do I trust a forecast? I mean, as much as I can throw something that's very heavy, not much, right? Like it's good to understand where people are trending, because a lot of investors, especially larger investors, are going to make their decisions based on these trends and where they think the market's going to go. But in general, I want to see historical data. I'd like to see forecasts, but then I'm going to make my own decisions based on kind of where we stand and what we think is going on. So where do we stand currently, 2023? They see the same thing as far as kind of the downturn with inflation kind of dropping, which is good to see because we're kind of hyperinflated right now. Versus this is the actual CPI, the Consumer Price Index. You can see they've highlighted a couple of years where back in when everything dropped out. I kind of highlighted again where they expected it to drop out, but didn't quite happen as far as a massive drop. And then we saw where everyone has experienced a rise here. And it's interesting to see what has actually risen in value or expense versus what hasn't. You know, a lot of wages have not really risen with the cost of living. And so it will be interesting to see if the cost of living actually does reduce and continue to reduce to where wages don't need to rise as much. But that's going to be from the multifamily perspective, as you guys are looking at your items. One of the things we often see in our underwriting is someone might be offering, I don't know, $40,000 a year for a maintenance worker, where now we're budgeting, you know, sometimes $60,000 to $70,000 a year for a solid maintenance worker. So just something to highlight of like understanding how something as much as, you know, CPI and inflation can affect you. It's not just cost of goods. There's labor involved and kind of seeing where all that is balancing out and really kind of expecting it too. We are anticipating with our pro formas now, that is one thing that a lot of people are underwriting. We feel too liberally, like that not enough money is being put towards labor. And in order to keep good labor, which is getting tougher and tougher, you really need to have the money budgeted to make it happen. So just one thing to consider how CPI is affecting us outside of just cost of goods and really inflation at large. All right. Next up, we got inflation, interest rates. I don't know if 10-year treasury. Oh yeah, so I'll let you talk to this one, Reggie. What we pulled here was basically a graph comparing federal funds, the Fed's rate versus the 10-year bond. If you want to talk to kind of the comparison and why we look at both of these.
Yeah, so I try to keep my finger on the pulse of what's going on in the marketplace, and I look at the Fed funds rate. So that's the rate that the federal, that the Fed charges banks to, lend money back and forth. That's kind of their overnight rates. And it's the 10-year treasury. You can see it trends similarly, but there are times when it doesn't necessarily follow the same pattern. But the Fed funds rate does impact interest rates. Interest rates impact lending, and interest rates and cap rates tend to trend together. And so as interest rates go down, you'll see cap rates compressed, and you'll have to pay more for every dollar of income that you're buying at an investment property. And likewise, when cap rates go up, you'll tend to see market valuations go down. You'll see, buy and sell activity decline and just, sometimes altogether cease because, properties, those transactions don't make sense anymore because they can't cash flow. And so when you get to a point where interest rates are above your cap rate, that's when it makes sense to have less leverage, less debt on your property. So, we're kind of at the end of this 40-year cycle. This has been happening since the early 80s. If you guys haven't checked out this guy named Ray Dalio, he talks a lot about this cycle, and he thinks we're about to see this big, basically like we're at this inflection point of this 40-year, this longer business cycle, and he thinks there's going to be a lot of change. But interest rates they really can change things, especially if one of your strategies is to refinance. If you bought a property 3 years ago and you wanted to refinance in 2022, like maybe in December, January, interest rates have more than doubled since then. And so your projections aren't going to be accurate anymore. So it's one of the reasons that we always recommend to have multiple exit strategies.
Absolutely. Exit strategy are a big play here. You brought up Ray Dalio's book, Changing World Order. If you guys haven't read it yet, he's a YouTube video about it as well. But I actually had it up because I was looking at it earlier as we were talking trends. I was like, oh yeah, I wanted to look at his graph again because it's been about 3 or 4 months since I looked at it. And this is what it is. I had it up and you were just talking about it anyway. So he's talking about basically the trends of the great empires of the world and how US here being this blue line is now on decline, with the red line of China being on the rise, and effectively having a changing world order where China he's protecting is taking over. Now, I will say again, understand where this data is coming from and the predictions. Ray Dalio, very influential financial person, we'll say, he has massive investments in China. Now, you could look at that two different ways, right? Look at it two different ways. He has massive investments in China because he really truly believes this is going to be the case, and I think he does. He could also be prompting more people to invest in China because he also has massive investments in China, right? And so you just look at where the data is coming from as far as he's saying, oh, China's where to invest, is the great place to be. Oh, and by the way, if you invest in China, you're gonna 10x my net worth as Ray Dalio. So I'm not saying it's wrong, just understand where the data is coming from. That's all. The two other points I'll bring up when it comes to interest rates are understanding LIBOR and SOFR, SOFR, or however you want to say it. Does anyone know what LIBOR stands for? And I'll show you the graph here in a second. Has anyone heard of LIBOR?
London Interbank Offering Rate.
Damn, Paul, did you look that up, Agu, or do you knew that?
I'm a financial advisor.
Oh shit, you know all about it then.
There we go.
So Paul, you can correct me if I'm wrong then. So my understanding, this is basically the rate that banks lend to each other, right? Like, hey man, it's overnight ranks. Like I need this money to cover my basis. I'm going to pay you back tomorrow, bank to bank. Here's the rate, right? Is that it in a nutshell?
That's exactly it. And that's the reason why what happened in 2008, you had some of those banks that were offering, but they had so much debt that they couldn't pay back. And the yield spreads were so small that it was going to happen. But they're getting rid of LIBOR and they're transitioning now to that.
What are they transitioning to?
I can't remember the initials all of a sudden.
They're using SOFR now.
SOFR, yeah, that's right. Thank you, Dan.
Oh, interesting. Okay, because SOFR is just the secured overnight financing rate. This is SOFR. My understanding is this is borrowing from the government versus borrowing from banks. So LIBOR is bank to bank. SOFR is bank to government borrowing. So this is the reason I bring these up, because if you're going to look into bridge lending specifically, which is it's normally going to be either tied to LIBOR or it's going to be tied to SOFR. And so you can see the trends again of LIBOR. You can see the trends again. Here's the SOFR graph of
The lenders
SOFR.
aren't using LIBOR anymore.
Yeah.
What's that?
We're only using SOFR.
Using LIBOR. They're only using SOFR now.
Only using SOFR. Okay. Yeah, I know one of our lending. I know we had some underwritten with LIBOR, but it's been a while. It's been probably a couple of years.
Yeah, they just changed it like in the last year.
Great. Okay, even better. Simplifies our life. So SOFR is what we're looking at. But you can start to see the trends of where we sat from 2020 all the way to slowly stepping up, right, to what these rates are looking like. And again, trend data, if you're looking into bridge lending specifically, which is typically going to be tied to this. So one of the things that's really screwing a lot of people is that they accepted floating rates without rate caps, in the 2020-21 timeframe, thinking, hey man, life's great. I'm getting a 3%, 2% debt. Sure, I'll take a floating rate if it saves me 0.25%. And now they're really feeling the pain. Some people feeling the pain of like 11% debt right now. It's really crushing their cash flow.
That's exactly what happened with many of those banks right now that are going under, because they didn't have the same credit oversight that some of the larger financial institutions had. And what they did was they all bought longer term bonds. And of course, as those bonds started to, as the Fed started to raise rates, the bond value goes down. So when you try to sell your bond, nobody wants it. So their overnight rate, they can't pay on it anymore. That's the reason why if a mid-sized bank has less than $500 billion, they didn't qualify for the credit oversight that some of the larger financial institutions, and that's the reason why some of them are all going out of business, because there was no oversight making sure that they were lending and doing investment practices they shouldn't have.
Yeah, even some of those sponsors that did rate caps, they're still getting screwed because maybe they just didn't pay enough that they were supposed to pay because they thought they could save a couple $100,000 on whatever rate cap. And so their rate was, call it 2-3% higher than where they initially underwrote. And even that 2 to 3% is just destroying them. It's like 2, 3, 4x what they were paying per month. And there's just going to be a lot of opportunity here in the near term.
Yeah, for sure.
That happened to me, and I'm going to humble myself. It happened to me when I was a young person. I bought my first house when I was 21. And they were like, yeah, you qualify for this house. I was like, nice, like $5,000, $10,000 down. And little did I know that they did a 30-year loan for the first 2 years fixed. And after the second year, I had a floating rate. Well, that was in 2001, 2002. And of course, after the the tech bubble that happened, rates had dropped down, but then they started rising. Well, my rate changed every month. My payment was going up like $100, $200 in like 3 months. It was like $350, and I had just gotten divorced, and I was like, "Whoa, I can't afford this now, buddy." So that's what made me want to learn more about finance.
Yeah, for sure. I mean, I'm always weary of any sort of floating rate. I'm not saying I'm not going to be willing to accept it, but you need to understand where the cap is, and you need to underwrite to that cap. If you don't work at that floating cap rate, you're really accepting risk that unless you're only investing your own money, which is, we're really not in the business that's what this is about. We're all about investing other people's money here. You need to kind of have that fiduciary kind of mindset of putting them in a position where you're not going to lose their money. Rule number one, right? So
yeah, and just real quick to piggyback on Paul's point, what got the banks into trouble and why they didn't see it coming, or why nobody else saw it coming, I think internally they did, but the accounting rules say that you don't have to adjust bond values. So from the original purchase price. So when they bought that bond, it sits on the balance sheet at this certain value and it doesn't change until they have to sell a bond. That first bond that they sell, that triggers an accounting event that they have to completely reevaluate, revalue all of their bonds. And the only time that a bank will sell those bonds is when they need money because their deposits aren't they're not sufficient. And so there's no telling how long that it's been like that, or how long before they saw this coming. But I think I saw that the SVP of the risk mitigation department, he was like, he either worked for Enron or the Lehman Brothers. Like seriously, yeah, can't make it up. But yeah, anyway, I thought that was an interesting detail about the whole thing.
Nice.
That's interesting.
Okay, we'll jump on and try to finish up this section at least. So that was interest rates. So that was the kind of first economic factors that to kind of bring into play for a broader understanding of kind of market cycles and understanding where we are. The next one we're going to discuss is home affordability, home ownership, medium income, population growth. So in general, a little bit more of a personal level, what we're looking at here. So home ownership rates, we kind of discussed this earlier as well. As far as trends, this isn't just, none of this data is black and white, right? And all of this data is skewed, and just like any stats, it can be skewed one way or another to be perceived. You turn on CNN, you turn on Fox, you see the same story, but skewed two different ways, right? So for me, I just look at general trends with the understanding of how, generational differences are going to apply. But you can see in general, 65 to 70% is considered a normal or healthy home ownership rate within America. This has shifted a little bit with, again, with investors buying a lot of single family houses and owning single family houses in large swaths. But in general, again, it's just one more trend to kind of take into consideration as far as home ownership in the multifamily space. If you start to see a massive drop in home ownership, depending on where you are, again, I would look regionally to where you are to see how that might play a role. And this did play a role specifically for us when in Lake Charles, right? If we looked at Lake Charles in general, which is one of the deals we'll talk about, and I don't know if Josh has already done a deep dive into it, one that we backed out. But when we did the market study of this one, in general, we missed a lot of trends until we went in person and we saw things that were very hard to miss in person. And one of those things was I didn't just jump on Zillow before we went over there just to see the massive amount of homes that were available for sale out there. So just one thing to consider is home ownership. It definitely affects the rents in the area, right? Like if there's a massive amount of homes for sale, those prices are going to drop. And then home affordability is going to be on the rise, and where renters can come out and potentially buy properties, which is going to affect your overall occupancy. So anyway, that's home ownership. Reggie or Josh, any additions for home ownership you guys want to add?
I think as far as the Lake Charles deal, we were looking at similar to, I guess, home ownership rate, just absorption being a big
Yeah, and that was real. That was really the kicker, which we'll get to another time, another bat channel, if you will. But it was, yeah, we were about to get schwacked with a bunch of freshly remodeled apartment complexes out there. Okay, so that's home ownership at 1. Medium household income. Reggie, you want to discuss this one?
Yeah, so median household income is one of those funny metrics, but it's useful. I used to kind of ignore this. Actually, I used to ignore a lot of these metrics before I got into real estate, but this one is interesting for a number of reasons. Because when I think about a market, if I'm analyzing a market, I want to know, like, I want the national median income as a backdrop, because I want to know what the local MSA looks like against that backdrop. And then median household income is interesting because it can give you some insight into what renters can afford in that market. Maybe a market isn't affordable. Maybe there's a lot of speculation and cap rates are low, and it maybe not a good market to invest in. But one of the things, and this is something that we're going to be able to analyze, or probably something we'll do a deep dive into in another class. But you can use median household income to underwrite a property and develop a pro forma. Because if you know what the median household income is within a certain radius of your investment property, then you can kind of back into what would be a reasonable rate by saying, okay, as long as people aren't spending more than a third of their gross pay on household, on home expenses, they can probably afford that. And then you can kind of back into a monthly rent number. So if you're looking at a property and you're saying, I need to at least hit $1,500 a month by year 2 to make this thing profitable, but the maximum rent that you think that people can afford is like $1,200. Probably a signal that your rent expectations are a little high. So this can be a very valuable tool. But then also not just looking at the instantaneous number, but also looking at the trends. Are they going down? Are they going up? How long have they been doing so? What's going on in the external environment that could cause it to change in the future? Those are all things that I kind of think about when I'm looking at this particular metric.
Yep. The only thing I'll add is you might have said it, but really just comparing national average income to regional, just to have that comparison, national versus regional. And then this is again highlighting what we were talking about earlier. If you see the inflation, but then you see the decline in average rent or average median income. And so it's interesting to see how inflation is going up, but people are making less money. So what's really interesting, Matt, if you look, that's real median household income. So this has actually been adjusted for inflation. So wages are going up a little bit, but after you adjust for inflation, they are actually going down. So our spending power it's declining at the moment. Yeah. Cool. So one more thing to consider.
Yeah, as far as the household income goes as well, I'd say this is definitely an interesting point of reference to utilize, specifically with assets that saw significant growth in the last couple of years, probably markets too, if you look at it from a market perspective, like Austin, right? We own a deal in Austin, Texas, and the freaking rents went crazy for a couple of years. They were just skyrocketing 20, 30, 40%, like quarter over quarter, year over year. And it was basically an artificial level of growth. If you were actually to look at the real median household income, look at what the true legitimate affordability was in the market, you could see that everyone in that area wasn't actually going to be able to afford these new market rents. So even though you've got other comparable properties in the area that are all charging $1,500, $1,700, $2,000 a month, that isn't something that you should assume you'll be able to achieve when you acquire this asset, because the market is not going to continue to rise and it's not going to be that hot because affordability is not where these other properties are. And rents have actually gone down in a lot of those markets because of it.
Yeah, that's a good point, Josh. This is a nice check and balance. So if you look at all your rent comps and say it does look favorable for you, if you check it against median household income, that's kind of like some validation. It can help you develop the business plan, or it can help you make a decision to gracefully exit out of the deal.
Yep. All right. Yeah, go ahead.
Question real quick. So when you're approaching an asset, how do you balance between looking at median income and looking at comparable rents? Like how do you account for both logically?
It's a supply and demand issue as well as a medium rental in average income, whatever the word I'm trying to say. So you do have to balance too. So you can see, hey, there's a massive undersupply here. And then when you look at a supply, again, this is gonna be a different lesson on supply and demand. When you look at the supply of an area, you can be like, all right, maybe this is truly a lack of supply, but maybe it's an artificial lack of supply because, here's 1,000 units that are currently being renovated. They're going to be online next week. And those 1,000 units are really going to then change the actual supply and demand makeup. And then, rents, we can forecast going back down to what we consider achievable rents. So that's definitely a big consideration is comparing supply and demand, as well as population trends. They say 1,000 people a day are moving to Florida, and there's plenty of cities in California where there's tons of people moving out of California and into Austin, as an example. One of the reasons I was bullish on Austin is because of that exact fact. I say take into consideration if one employer has too much of an influence. I'm a big Tesla fan. Tesla has a gigafactory that was about to be online in Austin as well. And I took that into consideration as well, being a massive driver of economic development, anticipating that gigafactory alone could have risen the median income of the area. So it's going to be a little bit of all the above. And you'll find, Samar, in this entire thing, it's all about, it's an art, not a science. We'll show you as many numbers as we can, but it ends up being you got to paint your own picture when it comes to this, and we'll give you the brushes and we'll give you the paint and we'll give you our techniques, but you're going to end up painting just a little bit differently than us, and that's just the way it goes.
Yeah, and just to put just a little more, I guess, nuance on the question, I think about median household income as a proxy for the max rents that I can get based on that affordability formula. Everybody's always heard, like, to qualify for this property, to qualify to live here, you have to make 3 times rent or 3.5 times rent. And that's after you pull out taxes and you account for that 3x or that 3.5x number, that the median household income is a good proxy for max rents. Now, when I think about rent comps, I've started to think about it more in terms of that's our competition. That's who we're competing against. And so it's subtle. I mean, rent comps can tell you the same thing that median household income can tell you in a sense. But to me, they're like median household income, it's an average, global average. Those rent comps, they're going to be very property specific. They may have more amenities. They may have bigger floor plans, et cetera. They just may be in a nicer area. And, all that stuff has to be taken into account. But rent comps are competition, like competitive analysis. And then median household income is more for like max rent development. That's how I interpret those
It's interesting that y'all put it in that perspective. So the property I was working at in West Nashville, for a while, we were increasing rents in early 2022 pretty significantly. Like you were saying, Josh, in Austin, like 30-40% year over year. But the company essentially lowered our income requirement to 2.5% for renters so that they could afford to pay those higher rents. But as a result of that, our delinquency went up significantly at the property. Yep. So it's interesting to think about it from that lens. I didn't really think about it like that.
Yeah, a lot of people will poo-poo the mom and pop operators who haven't changed rent in 5 years, but a lot of those mom and pop operators, they get the rent every month, and there's something to be said about delinquent debt and not having it, because it also it eases everything else if you actually have income coming in versus artificial income, which we may or may not be experiencing currently at one or two of our damn properties. Which we'll talk some deep dives there, and hopefully you guys can learn from our mistakes. All right, so yeah, good discussion on that point. Next one we'll bring up is understanding population. Again, we're thinking big picture in this one. Population, if you guys have not seen these population pyramids, these are really interesting. I tried to find this site that I really like that I think they graphically to show them a little bit better, but we'll illustrate the point here. Understanding all this is an age breakdown based on percentage of the population. And in general, you don't want to be top heavy, right? In general, you don't want to have less young people than you have old people, because then bad things happen. And so this is the world population. So we'll call this a generally healthy population cycle, right? We have enough young people to replace the old people that are dying. That's in general what we're considering here. Let's go and we'll show you the United States. If I can type and click at the same time. So here's the United States. As you can see, there were some cycles here. You'll see it. We almost have a belt here in the 45 to 55 kind of range. And as you can expect, this was the baby boomer era. So we have a little bit of a non-linear growth here. We had a population boom with the baby boomers. 60s, 70s, not as many people were having babies. A lot of people were having sex, not as many babies, right? But after that, kind of normalized to kind of a normal population growth afterwards. But we are starting to see a slight decline. We're getting a little bit top heavy in America, but we'll see how the graph goes. But not as healthy of a population period as you would like in the traditional sense. We can look at something like Japan is a good example. Japan has a big problem. Japan has a very big problem with being top heavy. They're trying to incentivize as many people to stay in the country and as many people to come in the country who are youthful as possible. They are just an aging population that's only getting worse. And they can't reproduce enough Japan's going to have a big issue as these 40 to 60-year-old generation, as they get to the point where they can no longer work. It's going to be interesting to see how a country like Japan, first world country with everything going on, how they kind of react when these people can no longer work and there's not enough people to kind of replace them. Will AI and robotics truly be able to replace people? Maybe they're going to be just fine, but in general, that's not a good trend to have.
Yeah, and when you're looking at these from the perspective of an investment, whether it's local or national, if you have a top-heavy distribution, then that translates to future increases in labor costs because you have less people to do the work. You're going to have less skilled workers. You're going to have a lower demand for things because the population is going to start shrinking once the older generation dies off. Now, it creates opportunities in other areas like assisted living, independent living. But it still goes back to, like right now we have really tight unemployment. And that's one of the things that the Fed factors in when they look at continuing increased rates because they want to see employment go up. But, if we don't have enough people to fill those jobs as is, like, will they be successful doing that? I don't know. But these distributions can tell you a lot. And, I think a lot of countries, they're looking at demand collapse over the next 10, 20, 30 years. To put it in perspective, the US has been below replacement birth rates since about 71. And it's taken kind of this long for it to kind of propagate through the generations. Now we're starting to get that, top heavy type of distribution. China's real bad about it because they had the one child policy for years. Mm-hmm. And their GDP was, they were rocking and rolling, man, for a while. And they were just growing. Because they stole a lot of R&D instead of investing in it. So they were able to skip that line item on their income statements. But China's got a real problem on its hands.
Yeah, China's not as bad as Japan as far as being top heavy, but they are fairly top heavy as well when it comes to the population pyramids. And you can look at other countries that are, I think Mexico is one. Let me see, Mexico. Mexico's super bottom heavy, right? They're looking strong when it comes to population replacement as an idea there. I think India is another one. If I remember right. I haven't looked at these in a hot minute. Yeah, India is another one where you see like very healthy kind of population growth happening in some of these emerging countries, but other countries, the way their population is growing. So again, does this affect us locally? With your no, it doesn't affect you locally, but it's something to be aware of as far as population growth in general. How does the United States, compare to other countries when we're looking at general population growth? Like where do we stand? One of the other things you could consider is the type of investment niche you're looking into. Like right now, with the baby boomers having a little bit of higher rate here, we could consider assisted living facilities. I'm invested in it's like a 200 unit. I'm just a limited partner, but it's like a 200 unit brand new assisted living facility in South Florida. Do I think that market is going to be strong for the next 20 years? Yeah, I think it's going to be an absolutely fine market, just due to population growth and understanding population trends. Okay, cool. Beat the dead horse enough. All right, let's see. I think we can probably go over this. We'll go over the multifamily outlook, which if you guys have not seen the Freddie Mac multifamily outlook, it's a pretty awesome little thing they put out. This is going to go over a lot of the other finer points in the big picture, understanding cycles and where we are in cycles, and specifically multifamily, which is what a lot of you guys care about. So this is one of the big data points we'll go over. Then after this, we'll just quickly discuss what are some different investment strategies within each cycle and how you might consider changing your investment strategy within each of these real estate cycles. And then we're going to save the rest for next week. We're going to talk more economic, political, demographic considerations, as well as we'll get into supply and demand and talking more, CoStar regional, like hyper local, get in the weeds and some actual CoStar report stuff. All right. So jumping into the mix here. So Freddie Mac, this is their outlook. If you haven't read it, highly recommend reading it. We read it a couple months ago as a group when they put it out. I think Reggie sent it out to the group whenever it was released. This is 2022. I don't know why I'm looking at 2022. We'll look at it just because it's going to be good data regardless. All right. Unemployment we talked about. So it's going to bring in unemployment rates. It talks about jobless claims, things we've already discussed. So just again emphasizing why that's important. Absorption rates. Reggie, you wanted to kind of discuss this one?
Yeah, so absorption rates, it's really simple. This used to confuse me because I didn't quite understand. I just didn't have it put to me a way that I understood it. But it's basically just the change in net leases over a certain period of time. So if last year, you had X number of leases signed versus this year, if there was a negative change in that number in total leases signed, well, that's probably a bearish sign compared to if you have a positive number of units that, positive number of leases that have been signed. And absorption, you look at it in conjunction with deliveries. So you want to know how many new units have been delivered to a market. So if let's just say you've had 0 deliveries, so no new construction, but you have negative absorption or negative net leases signed, probably a bad sign. But if the market's been pretty healthy and then you have an onslaught of new units come online, but absorption is close to 0, if there's not much change year over year, hey, that means absorption was pretty strong. It means that all those new units that were delivered in the past year were absorbed. And they signed, leases. They were able to lease up all those properties, and so that's kind of a proxy for demand. Deliveries are a proxy for supply, but absorption is, you always want to look at it in conjunction with deliveries, because that looking at just one will only tell you half the story.
Yeah.
So I was actually looking at Tampa earlier today, and I was seeing net absorption in 22 was negative, and then deliveries were like around 5%. So what would that signify in terms of the market?
I'll look at it. So I would want to know the absolute number in deliveries. So, and I would also want to know how many units total were in the market. So, 5% of a big number would be a big change. But in general, like if you have net absorption or negative net absorption, it's typically going to be negative unless the change in deliveries year over year has been really high. So 5%, that doesn't give me a good feel for how many units they actually brought online. But I would want to know total number of units and then total number of deliveries to be able to give you a good answer on that.
Okay.
And like I said, that's kind of another indicator to the Tampa market that we were alluding to earlier, just kind of being saturated is really kind of what it comes down to as far as the units available. Cool. I pulled up the actual 2023 outlook now. I apologize for not having the wrong one up earlier. They start with, for the 2023, a lot of the things that we discussed already, CPI growth, because that was a concern, understanding Fed funds rate, everything we've already kind of discussed there. So happy to jump in, and I recommend you jump in and read this. year-over-year growth rates. So talk about inflation, which we've already discussed as well. Medium sales of price of homes. Again, so a lot of these discussions that we've already discussed, it's already part of their multifamily kind of outlook. And again, you can see this is different from the previous 2022 year because these things weren't as much of a concern. So this year in 2023, they realized these are factors we need to discuss and how they're affecting the current environment. Absorption rate's always going to be a thing they're going to bring into because absorption rate is always going to be a player. So you'll see that every year. Medium household prices, again, we've kind of talked about affordability there already. Rent change. This was an interesting one as well. So going over how has the rent changed from January through December year over year, to Josh's point earlier, I thought this was a pretty cool graph of seeing, all right, 2020 rents dipped, not a big surprise. It's, people were kind of freaked out, weren't sure what the hell was going on. But 2021, massive, exactly what Sammer was just saying in Nashville. You're looking at ridiculous rent growth. This is on an average of 16% from January to December in rent growth. So it's just interesting to see these trends and kind of what's going on and comparing them yearly to what we're looking at. Let's see here. Gross income change is going to go regional. Let's see if they have Tampa on here because we continue to bring up Tampa as kind of a data point.
I think I saw it.
Sorry, I'm losing my own direction here. Let me get a single page view.
Here it is.
Tampa Stan. Let's see, what do we got going on in Tampa Stan? August, October, January, July. So gross income change compared to August. So they had August to October of 2022. They had a net gross income change of, call it 2%-ish in Tampa, or Tampa, 2%-ish versus 8% comparatively. So you can see even the income change, right? It's interesting how these kind of compare. Anyways,
it looks like Tampa looks like it's -2 for the second half of the year.
Yes, exactly. Yeah. So they're seeing negative trends. So like it's all kind of alluding to the same fact that Tampa right now, unless you're getting a really killer deal, like not something I would personally want to buy, unless it's some crazy value add opportunity. I wouldn't want to buy something and the cap rates in Tampa are stupid, as you'd expect. And so it's like not even like you're buying something that's going to cash flow regardless of future value. It's just not a market that I'm super bullish for right now. All right, continuing down, multifamily permits. So this has a kind of a lot of things we talked about before as far as, hey, how does absorption affect and what are we looking at as far as not just current occupancy in a region, but like what is the future predictions as far as what are build outs? This is national as far as multifamily permits. So you can see there, multifamily permits, multifamily starts, multifamily completion. So permits in 2022 are still at the highest. So we're still expecting more build outs to occur. Completions, kind of staying about the same as far as number of completions per year. And then multifamily starts. There were still quite a few multifamily starts in Tampa alone. I could spit on like 3 other massive Class A developments being thrown up right now. And so, it's just interesting to see the trends as these are going on. And you can read the data here. They start talking about trends. They get in the weeds in their actual document here as well. Employment, we kind of talked to this already. So I'm not going to hit the head too much there. And then what else? There's one more graph I wanted to talk to. This one.
Anytime you see these big charts too, these Freddie Mac kind of analyses of all these different markets, if you notice that a market that you're potentially interested in investing in isn't on these graphs, that could potentially be a good sign because it means there's not nearly as many eyes on that market. The competition probably won't be as ridiculous, and obviously there's a lot of variables like we're talking about today, but it could be a good sign. Like if you notice, we look at this, you don't see Mobile on there, but Mobile's been great to us. You don't see Gulfport or Biloxi or Pascagoula, everywhere we own at Montgomery, but they're all great markets with not nearly as much competition.
Yeah, I mean, great markets is in the eye of the beholder as well, right? And there are some people who don't want to invest in those markets because population trends in those markets aren't. It's not like people are flocking to Pascagoula, Mississippi to live, right? Like this but that's a risk that we understand, and because we're familiar with those hyper local markets and those considered secondary market. Pascagoula is definitely not a primary market by any means. So anyways, yeah, you can see like Tampa here, they're talking about difference in starts of the past year versus vacancy change. Interesting. I can't remember what this graph actually, all points here. Rent growth. Here we go. This is the one I was looking for, rent growth. So you can see rent growth in Tampa in 2023, looking at 6% rent growth with the forecasted vacancy being fairly high in the Tampa area. You know, I guess that's relatively normal with what they're forecasting, historical average. Who's this right here? Washington, D.C. They're expecting some pretty high, very low rent growth and very high vacancy. So it's just interesting to see what we got here. Austin, where we're currently investing over here, they're expecting pretty low vacancy, but pretty high, or pretty high, Austin, fairly decent rent growth. We'll say average rent growth and high vacancy. So for us to consider in Austin, you know, they're expecting vacancies to continue to be slightly above average, we'll say. Top and bottom, this is just interesting gee whiz, depending on your metros, how people are looking at these different metros. So people are still feeling, you know, bullish as far as Tampa because of gross income, which is interesting, annualized gross income here versus vacancy rates. But again, trends are not looking good for me personally, but they're saying they're very bullish. And Austin, they're saying it's not good, which is we're kind of experiencing that. All that to say, let me see, multifamily price index, cap rate. This is the one thing we did want to talk to. So we'll talk cap rates and we'll talk investment strategy. We'll jump off after this. We'll try to get done in the next 9 minutes for you guys. So Reggie, you want to talk big picture cap rates? I know this is one you wanted to kind of hit on.
Yeah. So cap rates, this is one of those real estate, you know, it's real estate nomenclature that everybody talks about. Everybody has a different kind of perspective on it, but really it's just the net operating income of a property divided by the purchase price. Or if you already own it and it's several years down the road, it could be your net operating income divided by the value of the property at that time. So that'll give you a percentage. It might be 3% if you're in Tampa. It may be 5.5% if you're in Mobile. It may be 8 or 9% if you're in a rural market, a tertiary market. But it basically just gives you an indicator of, well, it tells you a couple of things, actually. It gives you it's an indicator of risk. So some people, I think, don't think about this, but a higher cap rate means you're getting the opportunity to make more money for less investment, for a lower investment. But it's also riskier too. So the higher the cap rate, the riskier the investment. All right. But it also tells you like how much income you're going to generate per dollar of property you own. So cap rates tend to, you know, like I mentioned earlier, they tend to trend with interest rates. They do have a sticky quality to them. Like as we've seen interest rates go up, we haven't seen cap rates go up at all. They've been relatively sticky, and we've seen that because sellers are unwilling to move off prices that they were, you know, peddling on properties from say 6 to 9 months ago, and they would rather do owner financing or offer assumable loans than drop that sell price. So it's been kind of sticky, which has been interesting. But yeah, I don't think I've seen this particular.
So this is just showing the Treasury 10-year Treasury bond, and it's just interesting seeing 2020 when money was free, basically. Cap rate spread was super broad, meaning, you know, some people were paying 2 cap in Miami, like big metros, New York. People were paying a 2% cap rate on these investments because money was so cheap. But you can see the cap rate spread from anywhere from a 2% cap rate to a 5% cap rate in 2020. That spread is kind of tightening, right? So the spread is the average of that spread is increasing. In our markets we're experiencing, we haven't noticed a crazy difference in cap rate yet. However, the trend is there that we expect, if this trend continues, we expect cap rates to be on the rise. So what does this affect you as a multifamily investor? Again, to your pro formas, like what are you considering if you need to refinance in year 3 and you buy something with a current market cap rate of 6.5% or 7.5%? Like, what are you going to put in your analyzer as far as your planned refi value in year 3? Are you going to plan on a 7.5% cap rate? Are you going to add a 0.5% or a whole percent? So it's all going to depend on kind of your gut feeling. Again, it's an art. There are standards. We can say, hey man, you know, plan on at least a 0.5% cap rate increase over the term of your investment before you refinance as a general rule of thumb to keep you safe. But sometimes based on trends, you might be like, hey man, like we might need to plan a point or a point and a half, cap rate change and see where it lands. Like, are we still in the black? If we buy it at a 7.5 cap, but then we go to get it refied, we're at a 9 cap. Like, does that put us underwater? And are we willing to jump into that investment if that's the case? So just, again, it's all an art as far as how conservative you want to be and how you want to underwrite these deals, but just something to be aware of. All right, that was cap rates. There's plenty of other things you can look in here. The last thing we'll kind of talk to, we'll just kind of go back, is just understanding the investment strategies quickly in the different cycles. So we understand big picture market cycle now. We've talked about the different variables at play and kind of why things trend one way or another. We understand, I think in general, we're going to accept that we're somewhere in here. Like we're somewhere in here. I think the vacancy hasn't hit. So I personally still think we're in hyper supply. And I think we're going to dip down into recession here soon. When, I don't know, man. I wish my crystal ball stopped working years ago. So I'm sorry. I'll let you know when it works again and we can all make billions of dollars. It's going to be great. But until then, we're going to be in this unknown territory pressing forward into the future. So Reggie, you want to talk kind of big picture, or Josh, whoever, assuming we're in a hyper supply or assuming we're in a recession versus a recovery phase or expansion, what are you guys thinking as far as investment strategies within each of these, and what are we thinking differently?
I mean, I personally like just the long-term hold model that we have so that we're not having to consistently worry too much about the existing state of the market or the future state of the market in terms of, what's the sale price going to be 3 to 5 years from now? Am I going to be able to return double my investors' money in a couple of years, or am I going to get fixed rate debt at a long-term, just a long-term hold, call it 5-10 years, where I can just wait out any potential recession, any potential downturn, any potential crazy anomaly that's going to happen in this ridiculous market that we've been experiencing. I'd say just the longer term hold where you have steady cash flow and a fixed rate debt, none of this adjustable stuff that screwed so many people. I think you're pretty safe. You're safe in the long term. And then of course, as things move, as things trend, if we go back to the recovery phase or the expansion phase or whatever shifts when the market starts to get better, as we continue to go through this cycle, then you have more exit strategies, you have more options, you have refi capabilities, you have the sale capability, you have all these different things you could do for your investors at that point. But if they're confident in staying in the deal, if you're confident in staying in the deal, and everyone's making money, everyone's cash flowing, you're not actually losing money on a monthly basis, I feel like that's one of the best strategies you can do, specific to multifamily.
Yeah, you're right. I think in general, if you invest right, you should be able to make it through any market, right? Especially if you have a long-term strategy of holding generational wealth like we do. I think that's the way to go. A lot of people, I'm assuming some of you here are looking maybe for the traditional syndication model, 2 to 5 year hold. And so like, what does that look like for you guys if you're in 5 to 7 year hold in typical syndication kind of flow? If you're holding on to a property and you're in a syndication at this point, now is not a bad time to consider a sale, to be honest with you. While the market's still in, hyper supply, still have significant or decent value, cap rates haven't plummeted yet. Or I say cap rates haven't risen yet. You still have value in those properties. So if there's a property you have significant equity, now is the time to consider a sale or consider a refinance to really capture that equity as needed, to jump into that. Looking forward, as we look forward to these, like I said, pro formas for me, I'm going to be even more conservative with cap rates. And why do I think cap rates are going to rise? Because what's going to happen, I'll kind of finish the story I was talking about in the beginning. There are I went to a multifamily meetup where there were some people who are part of these very, very large multifamily groups. I'm not going to name names, but there's some very large multifamily groups they're members of. And one of them specifically, one of the main guys, he's part of 90 different large syndications. And one specific syndication, and this is a common of about half of his syndications right now, he had to infuse a $3.5 million just to keep it afloat. There was a combination of factors, but vacancies are an issue, rising interest rates are an issue. Some of the other deals I was talking to with these operators, not uncommon to see these operators having to pour in $100,000 to $500,000 a month to keep these deals afloat right now. And that's great while you have the cash. That will not last forever. That store of cash to keep people, that their reserves, if you will, is only going to last so long. And the moment they get to the point where they are now extremely motivated sellers, or they get foreclosed on and the bank just wants to sell the property, that is then going to now be a comparison for all of us, which is then going to start to rise. The cap rates are going to rise, right? So once we hit this recessionary period, you should expect to see cap rates rise. So it's not going to be as easy to get refinances. Debt, I think, is still going to be high. Interest rates are still going to continue to rise at that point. But there are going to be quote unquote deals. We just got to get creative to make these deals work, working with banks director and some of those creative finances techniques we talked about before. As you jump into the recovery phase, I mean, if you could time it perfectly, yeah, man, this is the time to buy at the bottom of the market, of course, right? Sadly, we can't time this perfectly, but this is the best time to buy as you're getting now into cheaper debt. Most likely, you're looking at vacancies increasing. Cap rates are now going to be starting to suppress again, and you're looking at values just intrinsically going up because people are excited to buy more, and then we continue the cycle as well. Around more single family stuff, you can talk. Like it's better to wholesale in certain market cycles than others. It's better to flip in certain ones and buy and hold. But big picture, that's kind of what we're considering in the different market cycles there. Reggie, any other additions you want to color there? I'm just trying to close up before we get too late here.
Yeah, as the markets move through each phase, and whether you're looking at the national or the local level, I mean, you do want to watch out for some of the indicators, just so you can be prepared. I mean, like right now, I think we're at kind of approaching the end of that hyper supply phase, and so what that means now is, we probably want to focus on making sure that our working capital and contingency reserves are strong, because we might see a hit on the income line. Now, hopefully, the recession brings some good things along with it, like perhaps lowered costs, lower insurance rates, hopefully. So it's kind of a double-edged sword sometimes. I know, like, in a recessionary period, that's when you want to be on the lookout for distressed assets. So you're looking for undercapitalized deals, you're looking for foreclosures, bank-owned properties. That's when a lot of those things start popping up. But kind of the underbelly to that is, if a lot of that shadow inventory comes online all of a sudden, then it can just cause prices to just crater. So I don't think that is necessarily going to happen, but I did hear a pretty scary statistic the other day that 70% of the multifamily units 70% of the bridge debt is coming due this year. Like, it's maturing, and rates are they're very high right now. A lot of people, they're going to have to do cash in refis, or they're going to try to they're going to have to sell their property. So there's certain things to look out for in each phase. If you think about what's going on in the market, the fundamentals, it should be common sense. But if you go into a recession, make sure you got the money to weather the storm.
Boom. So I just want to put a nice bow on it all as we get ready to leave. Jude, Ben, Dallin, for you guys joining us for the first time, and for some of you others who feel like you're probably still more in the basic phase of the business. This seems like a lot. It seems like some of it went over your head. You're wondering how much of it is legitimately important. Pretty much all of it is important to some degree, depending on the market that you choose. But all of what we're talking about right now goes into the level of focus that you need to have when you choose your target market. And all that what we're talking about are the different metrics and data points you can utilize to determine what market you actually want to pick. Once you can pick and you can define and you can get really crystal clear and laser focused on one market, that's really going to allow you to skyrocket off, because you're not going to have to continue to do all this research for every single deal. This is more so a little bit on the macro level of determining the micro market you choose. And then there'll be specific anecdotal points that we'll look at as we dive deeper into underwriting of what we want to look at for each individual deal. But all this work, all of what we're talking about, isn't something you have to review every single time you look at a deal. So the more focus we can have, the more streamlined, the more efficient we can be as we close more deals. And again, Thursdays now are going to be a little bit more advanced. So if you didn't understand a lot of what we talked about, that's because this is a little bit more of the advanced piece of it. So maybe if it doesn't make a lot of sense to you now, it's definitely something that you'll be able to go back to later with the recording, refresh your memory, and definitely utilize this as you scale, pick that market, and just grow. So today, Thursday, Monday of next week being what, the 15th. We'll be back again then on this call. That'll be basically, I guess, part 2 of the cohort that we're doing right now for the beginner stuff. We're still finalizing out the curriculum kind of that we're doing for these cohorts. But once we do, I'm promising you, I know we've said this like 4 calls now, but I'm promising you once we finalize it, I'll send it out to everyone so you guys can get a more crystal clear picture on what you can expect over the course of the next probably month at least of curriculum and specifics we'll be covering. So sweet. I know it's pretty much 7:05. We don't have any more time, but I know we usually open it up for questions. So we have time for like 1 or 2 questions and then we'll split if anyone has anything.
Can I do have one. So you just said by focusing on one market, you can kind of bypass the need to look at all this macro stuff every single time you're analyzing a deal. But when we're in a market like today, where deal flow is super slow and there just aren't that many deals happening, do we have the luxury of just looking at one market?
I mean, you can definitely target another market if you want to, but the more focus you can have, the larger you're going to be able to scale. I mean, let's take Rise 48 for example. For those of you guys that had the opportunity to be here when Zach was able to come and join us, and if you didn't have the chance to be there, we record every call. So if you can go back, go in the shared drive, go to the Mastermind Education section, there'll be a tab that'll say like guest speakers, and click on the one that says Zach Haptonstall or Rise 48. He was great when he came to talk to us. But if we just look at him as an anecdotal reference point, he took his company from nothing back in early 2019 to over a $2 billion real estate company with over 220 full-time employees in like 4 years. And he was able to do so because he focused all of his energy in Phoenix, Arizona. That was all he cared about, the only market he targeted, and they own thousands and thousands of units in that area now. And he could have looked at other markets, he could have done other things, but his level of focus is what allowed him to truly take off and get to where he is today. So I'm not saying that you can't invest in another market. I mean, we did, right? We're in Austin, we're in Mississippi, we're in Alabama. But we haven't grown as fast as he did either. We didn't get to 2 billion in a couple of years. So it's really going to depend on your goals. And then I guess, like you're saying, can depend on the market cycle. If you truly just can't find a deal and you know you can go to another market that you understand very well and that makes a lot of sense for you, and there's someone maybe at least somewhat local to the area, sure, go for it. But then you're just going to have to do more research to determine the investability of that market before you jump into it again. So it's going to be more work for you, but
yeah,
you could totally cast a wide net if you want to. You can be a very opportunistic investor and just realize the cons there of you just need to spend a little more research before you jump into an investment. It's not a bad plan to cast a wide net with investments and be opportunistic. It's also not a bad plan to be hyper focused, because then you streamline a lot of decisions and you can make your decisions quicker and act quicker. So we totally feel you though. Like right now, deal flow is down for everyone. But if you just looked at the market cycle, we do expect deal flow to rise, and it's going to be in an environment where everyone's losing their shirts. And so the problem trying to get deals at these times when we're looking at a recessionary period is going to be the fact that you're going to be the crazy guy buying this stuff that everyone's getting foreclosed on for. You know what I mean? So it's going to be a different kind of discussion we're going to have. But right. as of now, yeah, you're not wrong either way. Both tactics work. I would just say pick one and focus on that tactic, whether it's being opportunistic or being hyper focused.
Yeah, just doing what's best for you, which will go back to the vivid vision and the goals that you have set for yourself.
Yeah. Cool. What else you guys got? Any other questions?
No, I know I don't have any questions, but I want to thank you guys for the information, because it is good to remember that when we are putting together our pitch deck to our clients, you know, you really only have like a 60-day window to make sure you're raising capital. And I think for those clients that are sophisticated, they want to make sure that you've done your due diligence. And I think this was good information to show us. Don't forget, this is where you can get some great data, as opposed to trying to, like, you know, find and spend a lot of time getting the data. That data is already there, right there for you. So thanks for putting it back in front of us.
Yeah, for sure.
Yeah, I want to make a point on that actually. So Dylan and I were looking at a deal in Fayetteville, North Carolina, and on paper, the financials behind the deal kind of made sense. It was worth diving deeper into it, but we had to like take a step back for a second and look at the market. And Fayetteville ended up being a terrible market that hit none of our metrics. So yeah, I agree with you, Paul. Like looking at the macro perspective changes how you're looking at these deals for sure.
Yeah, there's a reason people in the Army call it Vietnam. It's a crime's an issue, like we talked about. Crime's an issue out there. We'll talk more demographics and stuff next time, more regionally. But yeah, you're right. I mean, I'm personally an opportunistic investor. We collectively is 3 Beach between me, Reggie, and Josh. We call it regional. We're not hyper focused, but we are regional. Anything within kind of our bubble, we're willing to look at.
Yeah, and real quick, my 2 cents on what the guy said. I think it's good practice if you've got the time. Hey, maybe go pick another market you're interested in, go through the motions, because I don't think you just do a market analysis once. I think it's something that once you've done the analysis, you have this framework, you have this foundation, and then all you got to do is keep up with it. And as you if you own a property, you'll know what the fundamentals look like. You'll know how they change over time. And so doing it in another market, it can cast things in a different light and make you look at things that you didn't look at before. And you can take it back to the markets you do own in or that you're more familiar with. And, some of that cross pollination can be good.